Hi everybody, it's Justice Lee here. Welcome back to Finance with Lee. I've been working really hard, worked 7 days this week, and now on my first day off, I've been working my fingers to the bone here trying to get some content out for you guys. So today we're going to be talking about options. It's one of my favorite subjects. I'm hoping that you guys can understand how to trade options when I'm done with this video. And if you have any questions, please leave your comments down in the comments section, and I'll get back to you if I can. And let's get into it.
So, what is an option? Well, an option is a contract that's a derivative of an underlying stock. That doesn't really mean a whole lot, does it? But I'm going to get more into it. So, a call and a put. There's two basic types of options. That's really it. It's a call and a put. There's a lot of different things you can do with calls and puts, but at the end of the day, there's just really two types of options. There's a call and a put. So, a call, it gives the buyer the right, but not the obligation, to buy an asset at a predetermined price at any time before a predetermined date. So every call has a predetermined date, and that's called the expiration date. And they also have a predetermined price, and that's called the strike price. And I know this still might not make sense, but just give it a chance. So a put, that gives the buyer the right, but not the obligation, to sell an asset at the predetermined price at any time before a predetermined date. And then another important word to know is premium. So a premium, just like with car insurance, it's the price that the buyer pays the seller to have the right to have the option. So essentially, the buyer is paying a premium to be able to exercise an option, and it's kind of like a safety net, sort of like your car insurance. So if you buy an option, then your stock goes down to zero or something. If you hedge with a put option, then you won't lose all your money. You'll basically just pay the premium and then you'll get your money. So here's some of the basics. So for today, I'm going to pretend that today is May 20th of 2020, and we're going to talk about stock XYZ, a pretend stock, and let's say that that stock is trading at $10 a share. So if you look at this chart here on the left, this chart is basically an options chart, and it looks different on different platforms. If you're using Robinhood, it's not going to have this entire chart on one page. You're going to have to flip between a bunch of different pages to actually see everything. But this is kind of similar to Charles Schwab, which is who I use. They're a great broker, and so I did make this chart myself. I just used PowerPoint to create it. So it's not anybody else's work. You're not really going to see this anywhere else, but it's very similar to the one you'll see on Charles Schwab. I kind of use theirs to create my format because they honestly have a really great app and everything looks good. So it's really easy to understand when it's laid out like this as well. So the bid and the ask, you can see that the red and the green are pointing to the bid and the ask. So it's a spread, and it's the range that the option premiums are trading in. So the seller is always going to want the ask price because he's going to get the most money for the premium, and then the buyer is always going to want the bid price because they're going to pay the least for the premium, and then they'll each basically say what price they want to pay, or they'll just put in a market order. A market order just means they'll pay whatever price the other person's willing to do the deal at. But the trade usually happens somewhere in between, right? And if it's a buyer's market, then it's going to go more towards the bid, and if it's a seller's market, it's going to go more towards the ask. And over time, the price of the option will vary based on what the demand is. So in this case, you can see at the top of the chart, every single one of these options is going to expire on June 17th of 2022. So they're only valid for the next 29 days, basically the next month. And then after that, their value is worthless, right? So unless they get exercised within before the expiration date, then they lose all their value. So they are a time-sensitive instrument. So a call means that the buyer can call away the shares from the seller at any time before the expiration at the strike price, no matter what the market price currently is. And then a put means that the buyer can put the shares to the seller at any time before the expiration at the strike price, no matter what the market price currently is. And if you can follow that, then great. If not, again, I'm going to get more into it, so hopefully that will all get cleared up. The strike price is the price that the contract stipulates the option can be exercised at. So if you look in that middle column, those are the strike prices. If the stock is currently trading at $10 a share and then you want to buy a put for $9 a share, obviously the stock's got to drop a lot before you're able to actually make any money by buying that option. That's why they're cheaper. The further away from the current price that the stock is trading at, that's why they get less expensive the further away they are, because the stock's not likely to go way up in value and it's not likely to go way down in value. So the further up or down away from the current market price, the lower the price of the option is going to be. And I'll show you that. It's also important to know that options leverage 100 shares. So if this stock XYZ is trading at $10 a share, one option at $10 is going to leverage 100 shares, and that's going to be $1,000 worth. Or if you buy the $9 strike, that's going to leverage $900 worth. So each option basically leverages at 100 times. So that's one of the reasons why options can be so dangerous, is because they do use leverage. So you can control a very large amount of capital with a very small premium. Which can be good in some cases and bad in really a lot of cases. Yeah, the chart to the left is showing options, like I said earlier, for company XYZ, which is something I completely made up, which has a market price of $10 a share. Market price just means that's what it's trading at today. Like if you were just to go onto your brokerage app and buy it, that's what you would pay. So for each one of these, if you're looking at let's say if you look at the puts for $9 and you look at the bid and the ask, it's 25 cents and 30 cents. But if you were to actually buy that, and let's say you bought that at the bid, you bought that $9 put, it would actually cost you $25 because everything is multiplied. And I put in the slideshow, if you were to purchase the $10 call at the bid price, that would cost you $50 because it says 50 cents on the chart, but you have to multiply that by 100. Because it leverages 100 shares, so it would cost you $50. So this also means that if you were to exercise the option seller would have to sell you 100 shares of XYZ at $10 per share, no matter what the current market price is. If you were to buy that call, that $10 call for $50, no matter what, like let's say the stock went up to $12 a share, anytime before the expiration date, which is June 17th, then he would have to sell it to you at $10 a share. And you're saying, well, why would he have to sell it at $10 a share if it's trading at $12 a share? Well, that's because he promised that he would when you gave him that premium. So you gave him $50, and now no matter what, the stock could go up to $1,000 a share, but he's got to sell it to you at 10 because you gave him that premium for the right to do that. Option expirations. Again, this one is for June 17th, which is going to be a 1-month option if it was May 20th at the time. There'll be a chart for all the expiration dates that are available for that stock. So there might be some weekly options, there might be some monthly options, quarterly options, or yearly options, and you'll be able to scroll through all the options that are available and see charts for each one. And options generally expire on Friday. Okay, so if it's a monthly, it's going to be the third Friday of the month. Obviously, if it's a weekly, it's going to be just every Friday. If it's quarterly, it's going to be the third Friday of the month that's at the end of that quarter. And if it's yearly, it's usually going to be the third Friday of January of each year. So there are some exceptions to this rule for holidays. There are also some exceptions like SPY, that's a ETF for the S&P 500. That one has a lot of option activity on it. And so there's options that expire, I think, almost every other day. So like maybe it's Monday, Wednesday, and Friday. There's just a lot of options for it. So again, there are exceptions, but generally options are going to expire on Friday. Also, keep in mind that not all stocks are optionable, especially if they don't have a lot of trading volume, then they may not even offer options at all. So just keep that in mind. So next I'm going to talk about out of the money options. Notice that the calls that have a strike price that's greater than the market price are not shaded. So all the calls that have a strike price that's above $10, which is the market price, they are not shaded. As you can see on the left-hand column on the bottom, as the price goes up, they aren't shaded. All the puts that have a strike price lower than the market price are not shaded. So if you look over on the right-hand column and look, starting at 950 and going up, Those aren't shaded. So what the lack of shading means is the option is out of the money. So that means that the option has no intrinsic value. The premium is entirely derived from extrinsic value. So I'll go into that more, what intrinsic and extrinsic value means. So if you were to purchase the $10.50 call for the bid, the total price would be $30, right? Because you can see it's 30 cents there, but it does leverage 100 shares, so it's going to be $30. So if you were to exercise this option immediately, you would purchase 100 shares for the price of $10.50 a piece from the seller. Since the market price is $10, you would lose $50 a share immediately. So you're saying, why would you ever do that? Well, because an out of the money option, you're only paying $30, but let's say before the expiration date it goes up to $11.50, then you could buy it for $10.50 and you could sell it for $11.50. So you'd make $100 minus the 30. Obviously, you'd make $70. So out of the money options currently don't have any intrinsic value. They only have extrinsic value. So in the money options, if you notice that the calls that have a strike price lower than the market price, they are shaded, and the puts that have a strike price higher than the market price are also shaded. So if you look at the shaded sections, you'll notice that they're in the money. That means they already have intrinsic value. And what that means is if you were to purchase the $9.50 call, obviously you could immediately exercise that contract and purchase 100 shares of XYZ for $950. And then since the stock currently sells for $10 a share, you could sell those stocks and make $1,000, right? So you bought it for $950 and you could immediately turn them around and sell them for $1,000, right? And the person who would be losing that 50 is the seller of the option, right? Because they'd have to sell you the shares at $950 when they're really worth $1,000. So obviously the seller's never going to price the option so that they would lose money. So the intrinsic value of $50 is already factored into the option price, which is the premium. So you'll notice that the reference option, which is that $9.50 call, has a bid of 70 and an ask of 90. So obviously it's going to be something above 50 cents. They're never going to sell it for less than 50 cents because they would lose money like immediately if you bought that option from them at a price that was 50 cents or lower. So they're not going to lose money. They are taking risk when they sell you the option, and so they're going to give you a price that's greater than the intrinsic value, right? It's going to be the intrinsic value plus the extrinsic value of the option. And I'll go into what constitutes extrinsic value in another video, but basically it's things like time value and implied volatility. So if the stock swings up and down really far all the time, having a high volatility is going to mean that it has more extrinsic value. And if the option is for the next 5 years, obviously the stock can do a lot of things in 5 years. So it's going to be a very valuable option because it has so much time to actually work out in your favor. So the seller's going to ask for a much higher price because there's so much extrinsic value. Why buy out of the money? So you're saying, well, if I buy out of the money and then I just go to immediately exercise my option, I'm going to lose money. So if you purchase that $10.50 call, right, you would lose 50 cents immediately per share if you exercise it right away. But if, let's say by the 27th of May, which is a week after you bought it, then XYZ goes up to $12. Well, in that case, it's going to have $1.50 of intrinsic value because the stock is trading $1.50 above the strike price. Plus, it still will have some extrinsic value. Time decay will have made it less, but let's just say you get $1.60 for it. So that would gross him $160 minus the 30 he spent on the option, so he would net $130. The buyer could also just exercise the option. Let's say he really loves the stock and it went way up, so he's like, okay, I'm going to buy this thing at $10.50 a share, and then he could just hold those 100 shares as a long position. So he's in a good situation where he can make money by selling the option to somebody else because it's worth way more now, or he could just hold the 100 shares and get them at a great price, obviously a price that's much below the actual market price at the time. Plus, when he first bought the option, he paid a lot less than if he were to have bought an option that had intrinsic value. So you're saying, wait a minute, hold on. So in our example, if the buyer purchases this $10.50 call, he spent 30 cents on the option premium, plus the strike is $10.50. That means it's got to go up to $10.80 just for him to break even, right? That's an 8% increase in value in just 1 month, right? Obviously, I just made these numbers up on this chart, but as you can see, purchasing options like this, calls or puts, I really don't think it's a good idea ever. You can get lucky and make a lot of money, or you can lose your entire investment when the option expires worthless. But it just takes a lot. The person who sells the option is going to price the premium so that they don't have a huge chance of losing money. If they were more likely to lose money than not, why would they ever sell the premium in the first place? So essentially, it's like a casino where they're letting you make bets where you can make a lot of money, but they know in the long term they're not going to sell things that are going to net them a loss in the long run. So the reason I showed purchasing options is because it's a lot easier to understand purchasing options than selling them, but I will show selling. I do only sell options, okay? I'll explain my option strategies in an upcoming video, but I'm going to do some more option strategies that I don't really like, and I'm just going to show them to you. I'm going to use Robinhood, even though I don't really like Robinhood, but a lot of people that I know use it. So I will show examples of a lot of different option strategies, and I'll actually perform the trades so that I can show you guys how they're all done. But I don't recommend doing anything but selling options, and obviously this is not advice to you. This is just me on YouTube. I can recommend something, but that doesn't mean you should do it. You should listen to a financial advisor. So here's my official disclaimer. Don't trade options at all unless you know the risks and fully understand and you know exactly what you're doing. Okay, obviously, please do not watch this video and just think you can trade options. I don't even know how good this video did at teaching you how options work. I'm hoping that you understand it. If not, please go back and rewatch it and try to understand, or drop a comment down there and I'll try to answer your question if you have it. But obviously, options trading, it can be absolutely devastating if you don't know what you're doing. Options trading can be very conservative, actually, even more conservative than just buying a long position. But if you don't understand what you're doing, you should never trade options.
I hope you guys enjoyed the video and you actually learned about options. Leave me a comment below. I'm going to put out more videos on how to sell calls, how to sell puts, how to buy calls and puts, and then I'll put out more videos about other types of option strategies like iron condors, trading spreads, and things like that. So just stay tuned and I'll be putting out a lot more options content. I'm also going to start to get into real estate and showing you guys different brokers and which ones I prefer. I'm going to be showing you guys my Robinhood account that I just made. I don't really care for Robinhood, as I said in the video earlier, but I'm going to show it because I know it's free and everybody seems to like it. So I'm going to show trading options, trading stocks, so that everybody has an example they can follow, and then it'll be really easy for you to just hop on, do what I do, and then you can buy and sell stocks, trade options, and make yourself wealthy. So have a good one. I'll see you in the next one.